joining. My name is Jeff Fisher, and I'm pleased to introduce Dr. Glenn Mueller, who graciously agreed to do this webinar for us. It's sponsored by RealNex. Glenn is one of our angel investors, and I've known Glenn for, gosh, well over 25 years. And I remember when he initially presented his psychoanalysis, which was at a meeting of academics at an organization called the Homer Hoyt Institute. And I think it's safe to say that Glenn pretty much invented this type of psychoanalysis, which I know a lot of institutional investors around the country subscribe to and follow and use as part of their market research. So just a couple more things about Glenn. He's a professor at Denver University at the F.L. Burns School of Real Estate Construction and Management. And he's been doing research on psychoanalysis and development and investments in real estate capital markets for many, many years. At the same time, he's also, throughout his career, been involved in working with different investment management companies. And he's currently a real estate investment strategist with Black Creek Group Research. And he provides the real estate market cycle research and investment strategy for them as part of their institutional real estate investment group for non-traded and public REITs. With that, I'll turn it over to Glenn.
Great. Thank you, Jeff. Happy to be here today talking to all of you. What I'm going to do is talk about real estate cycles. And for me, real estate is really a delayed mirror of the economy. And so what's happening to the economy typically follows through to real estate. And I'm sure you've all seen that in the past. I always start it with my students and tell them that there are three key things that drive demand for real estate that every good real estate professional should be watching on a regular basis. First one is population growth. And today's population in the US is about 340 million people. We're growing at just under 1%, or about 3 million people a year. So that means we need a place for each of those people to eat, sleep, shop, play, work, and pray. And thus, demand for real estate continues to grow. Second one is GDP growth, or the output of our country. Whenever that is positive, that means that there's typically more demand for real estate as well. And the official definition of a recession is 3/4 or more of negative GDP growth. And you can see on the graph here that 2009 and 2008 and 9, the Great Recession, we saw negative GDP growth. But currently GDP is running at a moderate rate of around 2% and expected to maybe bounce up a little bit, but kind of stay in the 2 to 3% range going forward. I actually think that's really good for real estate because the boom bust cycles we've seen in the past have been obviously a challenge for many real estate investors. And this more moderate growth has also helped to keep supply more in check in this cycle. And I guess my new idea is that we're going to be going lower for longer, and low is not such a bad thing for us, as we'll see as we go along. But the key and number one thing to look at is the employment growth, because every time someone's employed, they have to work someplace. And employment growth in the U.S. Since the Great Recession has been averaging right below the 2% rate, and that is expected to continue for the next number of years going forward as well. So to me, that is good news. We're adding right around 200,000 jobs every month. Very easy to go onto Bureau of Labor Statistics or BLS.gov, sign up for their email, and you will actually get the monthly new jobs created every month from them. At the same time, reporters get it, so I actually get to see it before it comes out in the news. On the cost side of real estate, there's two major factors that we need to be watching, one being inflation, which obviously drives up the cost of operating properties and the cost to build properties. And inflation has also been extremely low historically in comparison to what it's been for many decades, at a rate of just around 2%, and that is expected to continue going forward as well. As a matter of fact, if it does, then the Federal Reserve doesn't really need to raise interest rates. But then the other thing is real estate being a property type that is financed Interest rates are very important. And the two key metrics that most investors watch are the 10-month treasury rate that you see here in blue, because most commercial loans, which are only 10 years in length, are benchmarked off the 10-year treasury. 10-year treasuries have been running in the 2% range now since about 2011. And you can see here the forecast for that going up. But if you look back 5 years, you would have seen that forecast going up as well. And the economists have been wrong for the last 5 years. I still think we're going to see low interest rates going forward in a more moderate economy for the next 4 or 5 years. So I wouldn't expect to see interest rates hit 3% till maybe 2022. The other one is the 3-month LIBOR, or the London Interbank Offer Rate, which is used for short-term loans, many times used as benchmark for construction loans, certainly used by publicly traded REITs for their lines of credit that they borrow on to purchase properties with. And so that has been running sub 1% now for many years, and only recently, in the past few months, has risen above 1%. So we've got moderate costs for owning and operating properties, which is a good thing. Here, just historically showing you the periods of employment growth and the recessions in the black circles. And so the forecast going forward looks a little long, but it doesn't look much longer or any longer than other economic growth periods. So I think we can see historically that we're in a good shape. You can definitely see a more moderate growth in both employment and GDP than many of the previous cycles. And what is happening? Well, it certainly appears that economic cycles are getting longer. And it looks like by as much as 50%. Here you can see that the current cycle at just over 90 months looks long in comparison to things back in the 40s, 50s, 60s, and 70s. But since the 80s, we've seen longer cycles. And I think this current cycle could easily go as long as the 91 to 2001 cycle. I'm not moving forward here. There we go. Great way to show you that it is employment that drives demand. Here's total employment in the U.S., the black line, compared to the total occupied space of industrial, office, and retail. And you see that they move together as employment slows during recessions, where the line flattens out. Typically, you see occupied space drop off as well. The one property type that's obviously been expanding faster has been industrial, and kind of two major reasons for that. Number one, obviously the Amazon effect, I'll call it, people buying more things over the internet. But the other one, and probably the more important one, is more stuff. When I was a kid, my choice was Coke or Pepsi. And those had to be stored someplace before being delivered to the stores and the vending machines, etc. Now, I'm a Coke person. I've got Coke, Diet Coke, Cherry Coke, Vanilla Coke, Coke Zero, Lime Coke, on and on and on. And all those different assortments have to be stored someplace. So more stuff creates demand for more space. So
I think also, Glenn, a lot of the retailers, a lot of the retailers are downsizing too, aren't they? And then they're relying more on storing their goods outside the store, especially with e-commerce.
Right. Their storefronts are becoming more interactive experiences, seems to be what they're trying to do. And many times you can even go into the store and order online. So it's more of a place to try things on as opposed to store every size that you might possibly want, because people are used to, getting it the next day through delivery. So if we look at U.S. economic cycles for real estate, basically there's two types of cycle. The physical cycle, which is demand and supply for space. It is very local in nature, so you've got to look and know your own individual city. And then second, we'll look at the financial cycle, which is capital flowing into real estate, which is what drives prices. So in the real estate cycle on the physical side, the three things, and the cycle is what the three things we care about are occupancies, because increased occupancies obviously increase income, rents, because increased rents increase income, and then property prices, which drives capital appreciation either up or down. So on the physical side, we're going to look at the demand for real estate that comes from the jobs in any city. And every city has an economic base or multiple economic base industries that drive that city's growth. Best example, the easiest one is Detroit, Michigan. Obviously, the economic base industry is autos. If the auto industry is doing well, Detroit's doing well. If auto isn't, it's not. New York is finance. San Francisco is technology. San Jose is technology. Some cities have multiple things going on. Chicago has both finance and transportation and manufacturing as economic-based industries. So there's demand for real estate. Supply is how much space exists and how much new space is being put up. Those two interact to drive occupancy, and we're going to see that as we go through. Occupancy level, as we'll see, drives rent growth, and occupancy and rent together basically drive the income of the property. So here's my basic cycle idea. There are 4 quadrants to the cycle. This is the occupancy cycle, not the turn cycle. It just shows the level of occupancy, and each market has a different long-term average. Every market has a peak and a bottom occupancy level, but also a long-term average there in the middle. So 4 parts to the cycle: a recovery, expansion, a hyper supply, which means we've got more supply than demand, and a recession. And you can see declining vacancy on the way up, increasing vacancy on the way down. Typically in recovery, we don't build too much because we've got too much sitting around. Obviously in the expansion and hyper supply phase, we build a lot of things, start a lot of new construction. And then in the recession phase, the typical is that we're completing things that we're not starting a lot of new things, but we're completing things that were started either in the expansion or the hyper supply phase. These basically are going to drive rental growth. And so we see here now, I put numbers on my cycle. You can see 16 different points on the cycle. First 5 are in recovery, 6 through 10 or even 11 are growth, 12, 13, 14 hyper supply, 15, 16 the recession phase of the cycle. So at the bottom, when you have too much of any product, what do? You drop your price, so we get negative rental growth. As we start to come through recovery, landlords can finally start to raise rents, but typically at rates that are below inflation. And that occurs all the way to about 0.6 on the cycle, where we hit long-term occupancy average. That is a point which historically we will see is when we get to about inflation as far as rent growth. Above that, we start to get rents rising rapidly towards new construction levels. And you'll notice that I have 0.8 in green. And the reason that 0.8 is in green is that it's where we get cost feasible new rents. And by that, I mean, if the cost of building is $400 a square foot, and investors in new buildings are requiring a 10% rate of return, rents in the marketplace have to be 40 times 10% equals $40 a square foot. Until we reach that, it's hard to cost justify or pencil out and get a bank to underwrite your deal. Above that, the market continues to tighten as supply is trying to catch up to demand, and we get rent growth. We get continued high rent growth. When we hit the peak of the cycle, that's a point at which demand and supply are moving together at the same rate, and that's basically from your old Econ 101 class equilibrium. After that, one of 2 things happens: either we start putting in more supply than demand, which we did back in the 80s, or demand drops off while supply stays moderate. But again, in either case, supply is rising faster than demand. So we go through the hypersupply phase, and rent growth, while it's been positive, starts to decelerate or slow down. And then as we go back through the long-term average of 0.14, we go to low and negative rent growth in the recession phase of the cycle. So I did a study back now, I hate to say 20 years ago. I've been doing this for a long time, since 1990. You can see that I took the top 50 cities in the country and looked at what their rent growth was based on their point in the cycle. At the bottom, we get the negative rent growth at position 1 and 2, starts to turn positive. At point 6, we get to a 4% rent growth, which is almost identical to the historic inflation during that time, which was 4.2%. Above that, you see rents start to grow fast, and we get to the highest rate of rent growth at point 10 on the cycle at 12.5%. And then as we hit the peak and investors can look ahead, seeing more supply coming online, a lot of cranes in the air, or the economy starting to slow, rent growth starts to slow. They're not going to try and ask for as much. And we see rent growth start to back off 10, 6, kind of back to below inflation at position 14, and then low and negative in the recession phase at point 15 and 16. Same study in industrial, same results with the highest rent growth being at position 10. So if you know where your individual market is in the cycle, it will help you in making acquisition decisions, disposition decisions, leasing decisions, remodeling decisions, everything else, because you can get an idea of whether you got increasing occupancies and rents or decreasing occupancies and rents. So every quarter I put out my real estate market cycle report, which is now available to you on RealNex. And here you can see that I start by looking at all the major property types on a national basis, or sub-property types on a national basis, and where they are in the cycle. For me, I believe that the U.S. economy is actually probably at about 0.8 in the cycle. We recovered all our lost jobs by 2014, and we've been growing since then. Economists before the last election believed that we probably hit a recession in 2020, but now that we have all three branches of our government being business friendly, most economists have pushed out that forecast to 2022. Hence, we've got a couple of years yet of growth before the economy starts to really slow down. So think of the economy at 0.8, and what's happening? Well, to the left-hand side of it at points 5 and 7, we see office. And you say, well, aren't a lot of the new jobs being created office jobs? Answer, yes. But we've had a secular change in office demand, and that is, historically, we used to get 200 square feet per person. So every time we had a new person hired in an office-using job, we saw about 200 square feet get occupied. That doesn't mean everybody gets a 10 by 20 office. That includes the hallways, the reception area, the bathrooms, the meeting rooms, etc., but an average of 200 square feet. Now with hoteling and people benching and job sharing and working at home, etc., the new number today seems to be in the low 100s, like 110, and the average, U.S. average, has dropped quickly to about 150 square feet per person. So that means that we have to have anywhere between 25 to 45% more hires to get the demand for the same amount of office space as we did in previous cycles. Above that, you can see that most of the property types are doing better than the U.S., which means that there's decent demand, but restricted supply. In other words, we got more demand than supply, and so we are in the growth phase in all of those. And you can see peak hotel there, and that's because we held off on building a lot of hotel after the technology bubble burst in 2003, and only recently have we started to see a lot of new hotel rooms come online. The one property type that's over the top and in the hyper supply phase is apartment, and this is a case of demand actually being good, but supply being just too high. And my best example is Denver, where I teach. We have demand for about 8,000 new units every year, and have for the last 3 or 4 years in Denver. 3 years ago, we built 8,000. 2 years ago, we built 10,000. In 2016, we completed 12,000 units when we only needed 8,000. Hence, our occupancy levels have been dropping for the past 2 years. Landlords try to hold their asking rent at a particular point, but they're offering a lot more concessions and free rent. And we're finally starting to see rent numbers back off there. But again, key for investors, especially institutional investors that can go any place in the country to buy, they want to know what markets to go after. So here you can see the office market cycle report. And there I got the national average at 0.7. Again, just behind the nation, which I think is probably at 0.8. And you can see that there are markets spread all over the map here. Tightest markets, highest occupancy markets in the country today are Nashville, due to both music and transportation. It's a trucking capital of the United States, and warehousing, etc. But this is office. And at the bottom, northern New Jersey, where we put up a lot of new space, but people are wanting to be in New York City as opposed to northern New Jersey. And the one market that's over the top is Houston. Simple explanation, Houston had a lot of new supply going up for the expected demand from the oil industry. And with oil prices down, the oil industry backed off. And so demand dropped, pushing Houston into the hyper supply phase. Two other things to note about the cycle graph here are, number one, you can see that there are a number of markets that are in bold and italics. Those are the big markets, or the institutional quality markets that institutions are most interested in. There are a total of 13 of them here on the office cycle. And it's a little bit different in each property type, but here in office it's 13. Those 13 office markets make up 50% of all the square footage in the markets that you're looking at here. And while today I can get data on over 200 markets, these are the larger markets that most larger investors are interested in. And it's basically cities with more than 500,000 in population is an easy way to kind of make that cutoff. So there are a total here of 54 markets that we're looking at. Also, behind some markets, you will note that there are some numbers. Those numbers tell you that the market has moved from the previous quarter. So as an example, at position 9, you'll see Riverside and Tampa with a +1. That means they were at position 8 in the previous quarter, in the fourth quarter of 2016, and moved forward to position 9 in the first quarter of 2017. So not a lot of movement, and typically, this is a cycle, and historically, cycles have averaged 15 years or so. You'd expect to see cities move about once a year, sometimes a little faster, sometimes a little slower. And in some cases, you'll also see cities back up on it. And here you can see that Los Angeles, down at 6, actually backed up 1 point. It was at position 7 and backed up a little bit, mainly due to some new buildings coming online that increased the vacancy rate, decreased the occupancy rate. Okay. If we look at industrial, national average at 0.10 with a lot of markets at the peak occupancy. And that is because we've already talked about it, because of more stuff and internet buying, that there is a very strong demand for industrial, and we are building pretty much at about the right rate in industrial in most cases. As a matter of fact, fun factoid for all of you, last year, in the year of 2016, Amazon's new next day delivery has had them opening warehouses in many of these major cities around the country. And last year, Amazon leased 25% of all leases signed in the year of 2016. So they were the major tenant in that year. In Denver, they just announced new warehouse opening and the employment of 1,550 additional people to handle things going through that warehouse. Apartments, on the other hand, as I said, we're in the hyper supply phase, national average of 0.12. Still a lot of markets at the peak, but many over the top as we are building too many. Major reason for this is actually the fact that the government, Fannie, Freddie, and Ginnie, who make single-family home loans, also will make loans to apartments. And any apartment developer can pretty much lease up to market average within a year just by dropping their rents a little bit, because someone, at the same rental rate would rather be in a new building than an old building. So the oversupply is actually coming from a little bit more liberal financing on the apartment side. Hopefully that could slow down, and if it did, if the developers had a little more discipline, we could actually see apartments jump back into the expansion phase of the cycle because we've got at least 5 years of the millennial generation coming out of school, getting jobs, and renting with some really good growth in the marketplace.
Hey, Glenn,
this will probably surprise a lot of you.
Glenn, there's about a minute delay from when you advance to the next slide. I'm not sure you could do anything about it. It's probably the slower internet there at the lake house. But if you might try advancing the slide a little bit before you're finished with one, if that doesn't mess you up.
Okay. All right.
We see apartments now. Apartments just jumped up now.
Oh, really? Okay. So I've just talked about apartments. All right. I've now actually advanced to retail. So let's hold for a second, Jeff. And when you see retail come up, then I'll start retail.
Well, yeah, it could take anywhere from 30 seconds to a minute. So why don't you go ahead, but just be aware that some people may be looking at a previous slide. And there we go. There's retail. Then, while you're still talking about retail, okay, you could advance to the next one.
Great.
Maybe.
All right. Okay, I will do that. Thank you. Thank you for that. Okay. So retail, here you can see national average at 0.10, which means that retail occupancies are pretty high. And of course, this is data collected on major retail centers, not an individual building sitting on the side of the road owned by an individual owner. Retail occupancies have done okay. Major reason is that our supply has been very, very limited. Banks are very shy on lending to retail, especially new development. And the one thing that is happening is much retail is getting repurposed. Mall anchors that used to be major department stores are being repurposed with other anchor tenants. And millennials still like to go out and do things. As a matter of fact, they enjoy experiences even more than buying things. So we're seeing a lot more restaurants and theaters and experience-based things happening at malls, as an example. Of course, grocery stores aren't going away. We have a whole discussion about Amazon buying Whole Foods, but the cost to deliver to your house, they bought Whole Foods because it's a high-end grocer, and all Whole Foods are in very high-income neighborhoods. So those people probably are willing to pay to have stuff delivered to them, whereas other people aren't going to want, to add an extra $10 even to their $100 grocery bill. So it'll be very interesting to see how that plays, especially since grocery is the thinnest margin retail business on the planet. And Amazon, who hasn't actually made money on their online stuff yet, they make all their money in data storage, actually make something happen at work. So retail is doing fairly well in the majority of cities around the country. That near peak occupancy number in many cities comes from, again, these are all the decent quality pieces. Next, I'm going to move to hotel, and I've actually already clicked the slide a little bit ago, so hopefully it'll be coming up here. Hotel is at the peak of the cycle, and as a matter of fact, in looking back at historic cycles in hotels, in the past cycles, we have never hit 70% average occupancy in the United States in hotels. In this cycle, we are currently at 72.5% occupancy in hotels, because number one, the economy is doing well, so people are traveling for business, but also because millennials like experiences, and they travel more than their parents did, and so we're seeing really good occupancies, and didn't have a lot of new supply, but with these new above 70% occupancy levels, we aren't seeing a lot of new stuff coming online. Good example, New York City. I go there for a board meeting once a quarter, typically stay Midtown at a Marriott, and hotels have gotten to be very good at their revenue management now, kind of like the airlines. And one time I'll go and there's a lot of stuff going on in my hotel room. It'll be over $300 a night. And the next time I go, It's kind of dead and in room, same place, and I'm paying 150. So it will be interesting to see how hotels hold up here if we do continue this long, slow economic growth cycle as we go along. So that's a idea of where we are today. What I want to do now is talk about the fact that anytime we're investing or making a decision, we want to know where we're going. And so what I want to do is have you be sort of a student of major changes that happen in the industry so that you can be at 30,000 feet looking down at the forest instead of running around in the trees and get a good idea of things as they change. So I'm going to go back in history to the beginning of my career in the 70s and talk about what's happened with office. So early in the 1970s, we had strong demand for office space that stopped with a recession in 1974. After the year that I graduated from University of Denver with a degree in finance, unemployment rate was even higher than the Great Recession at 11%. And so I turned around and went to graduate school where I met my wife. We also had a lot of money coming in to build new office space, and much of that was coming from mortgage rates, which actually were started and sponsored by banks who reached their legal lending limits on real estate, and they found that they needed more capital, so they could start and sponsor and advise a REIT, take its money, and use it to make more loans. In the second half of the 1970s, the baby boom generation, that would be me, went to work, creating a lot of demand for office space. I call it kind of the beginning of the information age. I was one of 16 loan analysts in a trainee pool, and each week we had to do the underwriting on one loan, do a discounted cash flow going forward on a spreadsheet, but we didn't have computers. So we may were a big piece of green accounting paper and a pencil, and we'd do a 5-year discounted cash flow analysis. And if somebody made a change to an assumption, we'd turn our pencil upside down, erase things, and recalculate every single cell. So we needed 16 of us. Today, maybe 1 or 2 would be needed for this. Needed to with computers and everything else. Capital flow had shut down, so there was no new supply, and lenders started to recover, and we saw the markets tighten up fairly quickly and get to a peak occupancy level of 95% in 1979. As a matter of fact, hopefully my next graph has now come up, and what we see here is demand and supply in each individual year, and you can see that the first half of the 1970s, demand, the yellow bar, averaged about 2%, whereas supply, the black bar, averaged about 5%. More supply than demand means we're going through an occupancy down cycle during that first half of the decade. And then starting in 76, the market turned around quickly, and we had more demand than supply, allowing things to kind of move forward. So next decade, the 1980s, comes along, and those type markets were pushing up rents, and with rents going up, prices were going up as well. Many of you may remember that we had very, very high rates of inflation. U.S. inflation was in the mid to high teens in the early 1980s. We also had a very tough tax situation here in the United States. The top federal income tax rate in 1980 was 70%. That's right, it's $100,000, pay Uncle Sam 70 of it. Well, with the recession in 1980, 1981, the government put into place the 1981 Tax Act that basically said, if you will invest in a project that creates jobs and it doesn't make money, you can write that off against the the taxes on your personal income. And so a lot of taxable investors started to jump into real estate and do other things. My father bought a railroad car that depreciated and was rented. We also had thrifty regulation. It used to be that only commercial banks could make loans on commercial real estate, and the thrift and savings loans could only make the single-family home loans. They got deregulated. They started to make loans on commercial buildings, and that, and with no background in doing that underwriting properly, a lot of extra capital flowed into the development of office space. In the second half of the 1980s, Congress may be slow, but they're not totally stupid. They created the 1986 Tax Act, which we are still under today, where they separated our income into three baskets. One for our job, make money, pay tax. But they cut the tax rate in half from 70 to 35%. Another one, passive investments, buy stocks and bonds, make money, pay tax, lose money. You can only shelter it against other stocks and bonds that you're making money with. But you can carry forward 5 years or back 5 years at loss. And then, active investments like real estate. And again, if I made money in real estate, I couldn't use the loss from my stocks against my real estate income. If I lost money in real estate, I couldn't use it against my job income or my job for my stocks. Hence, that forced every real estate deal to be economically driven, which I think was a very, very good thing for the U.S. real estate. So that slowed down taxable investors, but it didn't slow down tax-free investors, the pension funds and endowments of the world, because between the years of 1975 and 1985, the total return on the U.S. stock market was zero. And when pension funds are putting away money to fund people in their retirement, and they used to use the actuarial assumption of a 10% return, 10 years of zero, they were underfunded, they were looking for higher returns, and they saw high teens returns in that decade in real estate and started to buy more real estate. And so the poor income returns were masking, if you will, what was going on, and prices were going up, hence people were still flocking to real estate, and we were building a lot. And so now hopefully the next chart has come up for you, and here's the supply and demand graph of the 1980s. In it, we will see that the black bars are all very high. As a matter of fact, the average per year was a 7.7% increase in new office supply. And the two fun factoids of that were that doubled the amount of office space in the United States in 1 decade. And the second fun factoid is that 80% of that new construction was in suburban offices. We created our suburban office markets in the 1980s. But the most incredible thing on this graph is the yellow bar at average of 3.8% growth. And you say, why is that incredible? Well, the population, as we talked about before, growing about 1% a year. And job growth was actually higher during that time frame because of the baby boom generation, my generation getting jobs, and employment growth is growing at 1.4%. So how is it possible that demand for office is growing at 3.8? Answer, the U.S. was going through an economic base change. We used to be a manufacturing economy. As a matter of fact, 25% of all jobs in the United States in 1960 were manufacturing jobs. Today, it's less than 8%. Office using jobs back in 1960 were about 8% of the economy, and today they are 30% of all employment. So that economic base shift was creating a lot more demand for office in the 1980s. Now let's move forward to the 1990s, and the factors that drove the 1990s. There was moderate but stable demand growth, even with a minor recession in 1991. all the oversupply of the 1980s created a lot of foreclosures, and we basically stopped building new things. And so the markets with moderate demand and next to no new supply started to recover. In the second half of the 1990s, that continued with decent demand growth and moderate supply growth. So we absorbed all the oversupply, and the actual returns in office investments started to come back. Another thing was that construction became much more harder. It was more constrained. Building a new building became harder. You had a lot more environmental impact studies and permits and things that had to be reviewed before you could start building. We also ended up with more efficient markets because of researchers like Jeff and myself being in the marketplace, doing better data analysis, not just coming up with reasons why the development that someone's already decided to do makes sense. So the bar slide for office demand and supply for the 1990s, and hopefully, has that come up yet, Jeff? Oh, Jeff may have stepped away for a sec. So I've now got the bar graph up for the 1990s, and in that graph,
just popped up,
the stark difference between the 80s. Okay, great. For the 1980s is that we had more demand than supply in every single year. And you can see that in 92, 3, 4, and 5, supply was less than 0.5%. And finally, by 1998 and 1999, demand and supply matched up nicely, which is really great. That means we were at equilibrium in the marketplace during that time frame. And it would be lovely if we could have an equal match of demand and supply every year in the marketplace. Real estate investments and operations and everything else would be much easier for us. So on to the next slide. In the next decade, the 2000 cycle, globalization actually, I think, helped create a more stable U.S. economy, although growth became more moderate. We did make the shift from manufacturing to technology as a dominant industry, economic-based industry in our economy. Many people will say that, well, wait a minute, isn't healthcare the largest employer in the economy? And the answer to that is yes. But healthcare is not an economic-based industry. It doesn't produce a better service that it sends outside of the local economy to bring money back in. It only services the people that live there, except in a couple of unique cases where there's a major research hospital like the Anderson Clinic in Houston or Cleveland Clinic. And Anderson is best known in the world for cancer versus the Cleveland Clinic, which is best known for heart. And so they do bring in people from all over the world who have their surgeries and medical procedures done. A lot more market data available, so a better feedback loop. The millennial generation started to come into the workforce. Also, there were more supply constraints happening, harder to develop again. Costs going up substantially on new development, and so we had a more moderate situation there happening. I've now pulled up the bar graph for the 2000s, and the yellow bar, demand and supply, we oversupplied some in 2000, and then for the first time ever since I've got data, we had negative demand growth for office space in 2001 as the technology bubble burst, and people who had leased office space to move into didn't even show up when their technology company vanished into cyberspace. That we got a recovery and started to have positive demand growth for office in 2002, rising to a peak in 2005. Then it started to slow and went back to a negative demand growth in 2009 during the Great Recession, and then started to pick up again. But here you can visually see that we oversupplied for a couple of years, 2000 to 2003, and if you kind of look at those two graphs, you'll see that those two different bar sets, you'll see that supply lagged demand by a couple of years as we went through. But by 2010, we were down to very low rates of both demand and supply growth, and that just finished the hyper supply phase and hopefully start our next cycle. So beginning with 2010, we've got a new cycle here. The keys here are slow economic growth. I think 2% GDP growth now becomes a norm. Potentially 2% inflation also becomes our new norm. We'll see if that actually can continue. The economic cycle appears like it will be longer this time. We may, and you may have heard some of this in the news, that we expect to see a longer economic cycle and may surpass the longest economic cycle in history this time. Again, those low interest rates at 2%. The millennial generation is a different type of workforce. They're a different type of consumer, liking experiences more than things in many cases. And that's going to change demand for space. Technology continues to do that. Certainly, I've heard many things about driverless cars changing demand for real estate, et cetera, as well. Baby boomers are retiring, creating another set of demands on income-producing properties. Certainly, medical office has gotten much stronger as our generation wants to be seen quickly and not have to go and sit and wait in a hospital a long time. Sustainability is the new key buzzword, but it's still employment growth that drives demand for commercial real estate. So moving to the next page, I show the long-term supply growth for all the major property types going back to the early 80s. In this chart, you can see that the percent of supply growth each year goes through cycles that basically follow our economic cycles, bottoming, if you will, in 2013 with the lowest rate of new supply growth seen in 42 years. And the last couple of years, including some forecasts going forward, are for moderate supply growth at lower rates than we've seen in any of the previous cycles. As a matter of fact, from C.D. Richard Ellis, found this next interesting bar graph, and it shows that while apartments currently in 2016 were 73% higher than the 20-year average for building new apartments. Office new construction is 13% below the long-term average. Industrial is 13% below the long-term average, and retail is actually 72% below the long-term average. Hence, the reason that the retail cycle is in a good position is because not because of good demand growth, but because of very restricted new supply growth in the marketplace. I've moved on to my 2010 demand and supply graph. Again, the yellow and black bars. As it comes up, you'll see that supply has outpaced demand here over the past 6 years, from 2011 to 2016. And demand is expected to slow somewhat as the economy moderates. Again, whether or not that's true will really depend upon the jobs and the millennial generation. But supply forecast to slow down with it. So that's one of the reasons that we're in an expansion phase of the cycle. My next graph is probably one of the key and most important ones that you're going to look at. It shows the occupancy cycle as a blue line and the rent growth cycle as a red line. And I'm going to wait to make sure that's up so you can see it. for me to explain, and I'm assuming Jeff will let me know.
Yeah, that
So
one hasn't popped up yet, but there was a question that came in. That one hasn't popped up yet. There was a question that came in. Would we be able to make the slides available to the participants, Glenn, since they did have a little hard time following the presentation?
Yes.
Okay, great.
Yes. Yes, we can make the slides available. So my office cycle, red and blue line graph still hasn't popped.
No, but it's up there now.
Okay, good. Okay. So now you can see why I use occupancy instead of vacancy. Visually, it just helps you see the correlation. And the correlations are very strong. As a matter of fact, the correlation historically has been 79%. So as office occupancies increase, rent rates increase. You can see the long-term average there at 89%, which is about an 11% vacancy rate. And office, and then the red line shows rent growth. And of course, to the right-hand side of the graph, you can see the zero there matched up with the long-term average. So when you're below the long-term average, you're getting negative rent growth. Above, you're getting positive rent growth. Also note that on the upper right-hand side, it says rents overall since 1991 have increased by 52%. You can see at the bottom there, negative 10%, 10.8% rent growth during the recession of 91, 92. Then over the next years, a plus 49%, then a negative 11, then a plus 17, then a negative 9, and then a plus 16 to current. So rents for office have increased by 52% over the past 25 or so years. So obviously really easy to model what you think is going to happen going forward. If you have a decent ID demand and supply, you can forecast occupancy, and once you know that, you can look at the historic graph to see what rent growth has been like. Different in each city too, so you're going to need the data for your city to be able to run an analysis like this, to be able to look at historic and model out the future. So the next slide shows my market cycle forecast report, which we actually sell on a subscription basis. And here you can see that I have the national average at 0.8 on the cycle graph. Is that popped up, Jeff?
Yeah, we have it.
So with all the cities? All right.
Yes.
Okay, right. And so while we probably expect the economy to be at 0.9, office at 0.8 cycle, and pick the city that you do your work in, and it's nice to be able to make a relative comparison of how your office market is doing compared to other markets in the country. And again, think back to what's driving demand in your city, what's the economic-based industries that are driving that demand, and how much new supply is going up. The next graph is the U.S. industrial cycle. Again, the red and blue lines. Again, the correlation between industrial rents and occupancies is the same, 79%. Here I've got a shorter time frame starting with 1995, and you'll see that overall rent growth since 95 in the past 20 years has been about 40%. The forecast there is for the occupancies to start to moderate a little bit as we're bringing more things online due to all the demand that we've had. But rent growth still positive, and as a matter of fact, this is maybe something for all of you to do, is to make sure that in your vocabulary, instead of saying that rent growth is decreasing, which sounds very negative, say that rent growth is decelerating. It's still going to be positive, but the rate of growth is slowing down. It's not turning negative. We're not dropping rents. We're just slowing the rate of increase. We're decelerating the rental growth rate. So hopefully now the industrial has popped up, and you'll see now, I believe that the national average occupancy will be at peak, and the majority of markets I expect to be there. Las Vegas, the one property type that's a little bit over the top because there's just a lot of new supply coming in Las Vegas. However, I'm going to be remodeling this myself because I'm not sure that I have missed the fact that Nevada has now legalized recreational marijuana, and the experience in Denver was that when recreational marijuana was legalized, it became a new economic industry. All the old crappy warehouse got leased up very quickly, and rent rates in Denver have gone from $3 a square foot to $6 a square foot over a very short period of a couple of years, as the marijuana industry has taken up all the excess space in the marketplace. As a matter of fact, it's one of the top two occupancy levels at around 98% in the entire country. So, as I call it, the pot effect has really driven and helped both retail space and industrial space in Denver.
And I would think as e-commerce keeps growing, that's going to extend out this cycle everywhere for industrial.
That is correct. It is.
Yeah.
It for the past 3 years, and even in the most current survey, it is ranked as the #1 most favorite property type by most institutional investors and by just about every investor that you could think.
Right. We probably need to wrap up in the next couple minutes.
And next. Okay, great. Well, I'm going to then skip forward over the apartment and the retail and the hotel forecasts. They're obviously doing a little bit better and moving forward than the previous, and move into the financial cycle here very quickly. And that is that capital flows are what affect prices. And so as and I'm just going to hit a couple of highlights here. One of the things I've now jumped to a bar graph that you're very used to seeing, Jeff, from Real Capital Analytics. And here it shows Real Capital Analytics monitors every commercial real estate transaction in the United States over $2.5 million. And if you ever get a call from an RCA analyst trying to confirm a transaction that you've been involved in, please give them the data so that we have better and more accurate data. So here in this graph, you can see capital flow at about 20 million in 2001, peaking at close to 160 million in 2007, dropping off to 15 billion in 2009, and hitting a new peak in 2015 at 170 million. And then the Real Capital Analytics Property Price Index, which most of you have heard of the Case-Shiller Home Price Index. Well, Moody's, in combination with Real Capital Analytics, puts out the Moody's Real CPPI, Commercial Property Price Index, and that's the red line. And there you can see that it is very closely following capital flows. The good news is this is also broken down by property sector. Hopefully that graph pops up here quickly. And it shows that by property type, CBD office prices are now 134% above their previous 2007-8 peak. Apartments are at 139% of their 2007-8 peak. Industrial at only 103%. Retail and suburban office still slightly below their previous price peaks in 2007 and 2008. Did that graph come up okay, Jeff?
The public debt capital flows just popped up. We were slowly cycling through each of the graphs. But there was a question about whether the recording will be made available, and we are recording the webinar, so I assume it's okay to post it up on the RealNex website for a while, and so people that can go back and listen to it.
Yes, it is.
Yeah. As the comment was, there was a lot of great content. It was just a little bit hard to follow since the slides didn't line up with your commentary.
Right. Okay. So as the property type pieces up there now.
We have the Real Commercial Property Times Price Index.
Blue, red, green.
Right.
Okay. Okay. I'm going to then pop forward to the property type cap rate. chart next. So I just cycled through a couple and jumped in. Hopefully yours don't come up and hang for a while. So it says property price cycle cap rates. Most of you know that we use cap rates to express value in commercial real estate. And of course, the easiest way to describe a cap rate, it's a cash on cash return. If I'm paying $1 million for a property, you get $100,000 a year in net rents, I got a 10% cap rate. Well, back in 1989, cap rates were running in the kind of 8% range. When we had the Great Recession, prices dropped and cap rates jumped to pretty close to 10%. Has that graph come up, Jeff?
Not quite, yeah. But of course, the big question is, as we kind of wrap things up, is here we go. Nope, we're on the city price index, but where cap rates are headed if interest rates go up, right, Glenn? That's the big question on everybody's mind.
Right. And Jeff, I think you even done some of this research. The correlation between cap rates and interest rates has actually not been that high in history. So don't expect interest rates to go up 1%. Cap rates are going to jump the same.
Yep, 1%. I agree. I think
correlation is actually somewhat low.
A lot of people are arguing that the cap rates are going to go up, 1 for 1 with interest rates. But as you know, the Fed would like to also increase the rate of inflation, and inflation has always been good for real estate. And a cap rate depends both on interest rates and on expected growth and income and value. And if we have more inflation and more growth in rents, that's going to keep cap rates down, or at least not go up 1 for 1 with interest rates. I think you and I agree on that. So we should probably wrap it up with this particular graph on the cap rates.
Pretty sure I saw a study. Okay. And so this graph just shows you that cap rates have been dropping over the years. And so real estate looks more expensive than it has historically. But the number one and key thing to remember here is that your clients today have to make an investment today, not 5 years ago or 10 years ago. And interest rates are at the all-time, 70-year lows. 10-year treasuries running close to 2%. And so the best thing to think about is, what am I getting when I buy real estate for the risk I'm taking above the risk-free rate of the 10-year treasury? Back in 2001, you used to get about 375 basis points, or 3.75% above the 10-year treasury for investing in real estate. In 2007, you were only getting about 150 basis points above the 10-year treasury. Today, with the 10-year treasury being so low, you're getting anywhere from 375 basis points above the 10-year treasury for an apartment building, around 5%, whereas industrial is in the 7% range. You're getting 500 basis points above 10-year treasuries for that. In hotels, it's even 600 basis points. So on a relative basis, real estate looks cheap in comparison to the bond market, and then you can make your own comparison about the stock market and where things are there. Also, one last point then to make, and I flipped to it, maybe it'll come up before I finish, is that in my career, when I started in the 70s, basically all commercial real estate transactions were local buyer, local seller, local bank. As the institutions came along in the 1980s, you had national buyers, national sellers, and national financing. In the 90s, real estate got its first access to public markets. The public markets, the stock market through REITs, and the bond market through CMBS, commercial mortgage-backed securities. And since the year 2000, real estate has really gone global, and Real Capital Analytics has started collecting that data as well. And my last graph, when it comes up for you, will show capital flows from the U.S. to overseas, and from overseas buyers coming here. Of course, just like the stock market, the actual winner of any auction on a property being sold is setting the market price. And we see foreign investors willing to pay higher prices, lower cap rates than many U.S. investors, because our cap rates are higher than we see in other countries. Hence, we've become a global marketplace and can't just look at the U.S. by itself. We have to look at the world as a whole. So with that, I will call us to a close. And Jeff, if there's any other interesting or pressing question, I'm willing to answer that if people have the time.
I don't see any other questions. And I know people are looking forward to being able to access the slides and the recording and go back through it again. So we appreciate it, Glenn. Thanks for taking the time to do this.
Okay.
Bye, everybody.
Okay, great.
Yeah.
Thank you all, and have a great day.